In the middle of the 20th century, the American middle class represented something that had never existed before at such scale. A factory worker could support a family of 4 on a single income, buy a home, send his kids to college without debt, and retire with a pension and Social Security. Home ownership was accessible, education was affordable, retirement was secure. This was not the experience of a privileged few, it was the norm for tens of millions of American families. Today, that reality is gone. Dual incomes are now necessary just to cover basic expenses. Housing prices have risen so far beyond wages that homeownership feels out of reach for an entire generation. College graduates carry tens of thousands of dollars in student debt. Retirement savings are inadequate, and the future of Social Security is uncertain. The middle class, once the foundation of American prosperity, is struggling to survive. Most explanations for this decline focus on technology, globalization, or cultural shifts. These factors played a role, but they do not explain the full story. What changed most fundamentally was not what Americans produced or how they worked. What changed was the money itself. Monetary policy, the decisions made about how money is created, distributed, and valued, quietly reshaped the economy in ways that transferred wealth from workers to asset owners, from savers to speculators, and from the middle class to the top. What happened to the American middle class, and what role did money itself play? The story begins in 1944, when America designed a financial system that would create the most prosperous middle class in history. In the decades following World War II, the United States established a financial system that would produce the most broadly prosperous economy in history. At the center of this system was the Bretton Woods Agreement of 1944, which tied the dollar to gold and made it the anchor of global trade. Under this arrangement, every dollar in circulation was backed by a fixed amount of gold held in reserve, and foreign governments could exchange their dollars for gold at a set price. This created stability. Currencies were predictable, inflation was low, averaging under 2% annually, and that stability provided the foundation for something unprecedented: a massive, thriving middle class. During this period, wages tracked closely with productivity. When workers produced more, they earned more. The gains from economic growth were broadly distributed, not concentrated at the top. A factory worker, a teacher, or a shopkeeper could support a family of 4 on a single income and live what was recognizably a middle-class life. Housing was affordable, with the median home costing roughly 2 to 3 times the median household income. College tuition was low enough that students could work part-time jobs during the summer and pay for their education, without taking on debt. Savings accounts offered real returns above inflation, allowing families to build wealth simply by setting money aside. Pensions were common, Social Security was solvent, and retirement felt secure. This wasn't luck. It was the result of a monetary system that preserved purchasing power over time. Because the currency was anchored to gold, the government could not print unlimited amounts of money. There was discipline built into the system. A dollar earned in 1950 held roughly the same value in 1960 and 1970. This made long-term planning possible. Families could save for a house, knowing their savings wouldn't be eroded by inflation. They could invest in education, knowing the cost wouldn't spiral beyond reach. They could prepare for retirement, confident that their money would retain its value. By 1960, the homeownership rate had reached 62%. Manufacturing jobs made up 30% of the workforce, and most of these jobs came with good wages and benefits. The middle class claimed the largest share of national income in American history, and income inequality was at its lowest point. The economic pie was growing, and the middle class was getting a substantial slice of it. The foundation of this prosperity was monetary stability. The gold standard imposed limits on how much currency could be created, and those limits protected the purchasing power of ordinary Americans. Money was not just a medium of exchange, it was a store of value that could be trusted across decades. Then, in 1971, the foundation cracked, and everything began to change. On August 15, 1971, President Richard Nixon announced that the United States would no longer convert dollars into gold. The link between the dollar and gold, which had anchored the global financial system since the end of World War II, was severed. The dollar became what economists call a fiat currency. backed not by a tangible asset, but solely by the promise of the government that issued it. For the first time in modern history, there was no hard limit on how much money could be created. The consequences were immediate and profound. Inflation, which had been modest and predictable for decades, began to accelerate. By the mid-1970s, it had reached double digits. The price of everything, rose food, gasoline, housing, consumer goods, wages struggled to keep pace. Families found that their paychecks bought less each year, even as the numbers on their pay stubs stayed the same or increased slightly. Savings accounts, which had once been a reliable way to build wealth, lost value rapidly as inflation eroded, purchasing power faster than interest could accumulate. The future became harder to plan for because prices were unpredictable. This era came to be known as stagflation, a toxic combination of high inflation, stagnant economic growth, and rising unemployment. For the middle class, the impact was devastating. Money saved was worth less each year. Real wages adjusted for inflation stagnated beginning in 1973 and never fully recovered. The standard of living that had risen steadily for a generation began to decline. Home ownership became harder as the ratio between home prices and income started climbing. The economic security that had defined the post-war years was slipping away. In 1979, Federal Reserve Chairman Paul Volcker took drastic action to break the inflationary spiral. He raised interest rates to levels that had never been seen in modern America, pushing them above 20% by the early 1980s. The strategy worked. Inflation was tamed, but the cost was enormous. The country fell into a deep recession. Unemployment soared. Manufacturing jobs, which had been the backbone of the middle class, began disappearing in large numbers. Housing became unaffordable in a different way. With mortgage rates reaching 15 to 18%, pricing millions of families out of homeownership entirely, a new pattern had been established. The boom-bust cycles that had been relatively mild during the Bretton Woods era intensified. The Federal Reserve now controlled the economy primarily through interest rate manipulation, expanding and contracting the money supply based on policy decisions rather than the constraints of a gold standard. The stability of the previous era was gone, replaced by a system in which the value of money fluctuated according to the judgments of central bankers. The purchasing power of the dollar entered a long, relentless decline. A dollar in 1971 would be worth more than $7 today when adjusted for inflation. Wages did not keep pace with the rising cost of living. Through the 1970s, inflation averaged 7 to 8% annually and peaked at 14%. Real wages stagnated and never fully recovered to their pre-1973 trajectory. The price-to-income ratio for housing, which had been stable for decades, began climbing steadily upward. The inflation was tamed, but the damage was done. And in the decades that followed, new policies would accelerate the divide. In the decades following the inflation crisis, the Federal Reserve adopted a new playbook. Money creation became the primary tool for managing the economy, and every crisis was met with the same response: lower interest rates and print money. When the stock market crashed in 1987, the Fed intervened. When the economy slipped into recession in the early 1990s, the Fed lowered rates. When the dot-com bubble burst in 2001, the Fed flooded the system with money. And when the financial crisis struck in 2008, the Fed embarked on unprecedented money printing through quantitative easing, creating trillions of dollars to purchase bonds and prop up asset prices. The effect of this policy was clear and consistent. Asset prices inflated dramatically. Stocks, real estate, and bonds all rose far faster than wages. Those who owned assets became wealthier with each round of intervention. Those who did not own assets, the working and middle class, fell further behind. The gap widened systematically, not because of individual failure or lack of effort, but because monetary policy itself favored capital over labor. Housing became the most visible example of this shift. In the 1970s, a house was primarily a place to live and a modest store of value. By the 1980s and beyond, it had become the primary wealth-building tool for most families. Low interest rates fueled bidding wars and allowed investors to purchase properties en masse. Median home prices, which had been roughly 3 times median household income for decades, climbed to 6, 7, and eventually 8 times income. Down payments that once required a few years of disciplined saving now required a decade or more. The homeownership rate peaked at 69% in 2004, then declined sharply after the 2008 crisis. Education followed a similar trajectory. College costs exploded, rising far faster than inflation. Federal student loan programs expanded, making credit easily available to students. This easy credit allowed universities to raise tuition year after year without resistance. Students graduated with tens of thousands of dollars in debt dredging. More than $30,000 per borrower delayed their ability to buy homes, start families, and build wealth. Meanwhile, the stock market reached all-time highs repeatedly, celebrated in the media as evidence of a strong economy. But the middle class owned very little stock. The top 10% of households owned roughly 90% of all stocks. Federal Reserve policy was enriching those who already owned assets while doing nothing for workers whose wages continued to stagnate. A clear pattern had emerged. Money printing benefited asset owners. It hurt wage earners and savers, and it widened the wealth gap systematically. The old model work hard, save money, buy a house, retire comfortably no longer functioned. To keep up, one had to invest and take on risk. Those without capital to invest fell further behind. Then came 2008, and the Federal Reserve's response would cement the new reality. In 2008, the housing bubble that had been inflating for years finally burst. Home prices collapsed. Millions of families lost their homes to foreclosure. Middle-class wealth, which for most Americans was concentrated in home equity, evaporated. The banks that had caused the crisis through reckless lending now faced collapse themselves. The entire financial system teetered on the edge of failure. The Federal Reserve's response was swift and overwhelming. It bailed out the banks with trillions of dollars. It launched quantitative easing, a program that created money to purchase bonds and inflate asset prices. It cut interest rates to near zero and kept them there for years. The stated goal was to save the financial system and boost the broader economy. But the reality of who was saved and who was not revealed a harsh truth about where priorities lay. The banks were rescued. Executives kept their bonuses. Shareholders were made whole. Homeowners, by contrast, received minimal help. Millions were foreclosed on and lost their life savings. The stock market, flooded with Federal Reserve money, recovered quickly and reached new highs within 4 years. The housing market also recovered, but the middle-class families who had been foreclosed on were now priced out. Investors and corporations, taking advantage of cheap credit, bought up the foreclosed homes in bulk. Wealth transferred from the middle class to those who already had capital. Interest rates remained near zero from 2008 through 2015, and then again from 2020 through 2021. For the middle class, the consequences were severe. Savings accounts earned nothing. Building wealth through saving, the strategy that had worked for generations, was no longer viable. Retirees who had planned to live off the income from safe bonds found themselves unable to do so. The only option left was to take on risk to put money into the stock market, often at all-time highs, or into speculative assets. Those without capital to invest simply fell further behind. Meanwhile, asset owners benefited enormously. Cheap credit-fueled stock buybacks, inflating share prices. Real estate investors borrowed money at near zero rates and purchased properties, driving prices even higher. The wealth gap exploded to historic levels. The Federal Reserve's balance sheet, which had been $800 billion in 2008, ballooned to $9 trillion by 2022. The stock market recovered and surged, but middle-class wealth took a decade to recover and never fully returned to pre-crisis levels. The homeownership rate dropped from 69% to 63% and struggled to climb back. The pattern was undeniable. Monetary policy now explicitly favored asset owners over wage earners. The Federal Reserve's dual mandate had, in practice, become a single mandate: protect financial markets at all costs. And then came COVID, and what happened next made 2008 look restrained. In March 2020, the economy shut down in response to the COVID-19 pandemic. The Federal Reserve's response was immediate and unprecedented in scale. It printed trillions of dollars. Interest rates were cut to zero once again. Stimulus checks were sent directly to individuals. The Paycheck Protection Program distributed hundreds of billions in loans to businesses, many of which were later forgiven. Unemployment benefits were expanded dramatically. The money flooded into the economy at a pace that made even the 2008 response look restrained. The consequences arrived quickly. Inflation, which had been dormant for years, returned with a vengeance. By 2021 and into 2023, the United States experienced the highest inflation in 40 years, peaking above 9%. The cost of groceries, gasoline, and rent skyrocketed. Real wages declined, meaning that even as paychecks grew in dollar terms, they bought less. Savings were eroded as the purchasing power of every dollar held in a bank account diminished month after month. At the same time, asset prices exploded. The stock market reached all-time highs. Housing prices surged by 30 to 40% in just 2 years. The median home, which had historically cost around 3 times median household income, now costs 7 to 8 times that income. Rents increased by 20 to 30% in many cities. Those who owned assets saw their wealth double. Those who did not own assets fell even further behind. The divide, already wide, became a chasm. The current reality for the middle class is stark. Dual incomes are now necessary just to cover the basics. More than 60% of Americans live paycheck to paycheck. A majority cannot afford a $400 emergency expense without going into debt. Housing is unaffordable in most cities. Student debt, medical debt, and credit card debt have become crushing burdens for tens of millions of families. Retirement accounts are inadequate. Social Security is facing insolvency. Median household income is approximately $75,000. The median home price is over $430,000. The average student loan debt exceeds $30,000 per borrower. Healthcare costs are rising faster than wages. Childcare costs, in many cases, equal the entire income of one parent. The middle-class share of national wealth has declined from 32% in 1983 to 16% in 2024. Household debt has climbed past $17 trillion. This is the defining reality of the present moment. The standard of living is declining for the first time in generations. Children now expect to be worse off than their parents. The American dream is out of reach for most. It is not a temporary setback. It is a structural shift that has been building for decades and has now reached a breaking point. So how did monetary policy cause this? And is there any way back? The mechanism by which money printing destroyed the middle class is not immediately visible, but it is precise and consistent. It begins with what economists call the Cantillon effect, named after an 18th century observer who noted that when new money is created, it does not reach everyone equally. The money enters the economy through the financial system, first flowing to banks, investors, and corporations. These recipients spend the newly created money before prices have adjusted upward. By the time the money trickles down to workers in the form of wages, prices have already risen. The result is that asset owners benefit, while wage earners lose purchasing power. This is not a side effect. It is the direct consequence of how money creation works. Federal Reserve policy inflates the prices of asset stocks. Real estate, bonds, but wages are sticky. They do not rise as quickly. Those who own assets grow wealthier with each round of money printing. Those who depend on wages grow poorer in real terms, even if their paychecks increase nominally. The wealth gap widens systematically, not because of individual choices or market outcomes, but because the structure of monetary policy favors capital over labor. Savings, which once allowed the middle class to build wealth slowly and safely, have been destroyed as a viable strategy. Inflation erodes the purchasing power of money held in savings accounts. Low interest rates ensure that savings do not grow. The middle class is forced into risky investment stocks, real estate, speculative assets just to keep up. Those without capital to invest fall further behind. The very behavior that built the middle class in the post-war era is now punished by the system. Housing has become a trap. Easy credit and low interest rates, maintained by the Federal Reserve to stimulate the economy, inflate home prices far beyond what wages can support. This benefits those who already own homes, as their equity grows, but it locks out younger generations who cannot afford to buy. Housing has been transformed from shelter into speculation, and the generational wealth building that homeownership once provided is now out of reach for millions. The pattern across decades is clear. In 1971, when sound money ended, the purchasing power of the dollar began its long decline. Through the 1980s and 2000s, Asset inflation accelerated while wages stagnated. In 2008, massive money printing caused the wealth gap to explode. From 2020 to 2024, the final acceleration hollowed out what remained of the middle class. The mechanism is straightforward. Print money, inflate assets, benefit the wealthy. Wages fail to keep pace. The middle class loses purchasing power, saving becomes futile, and housing becomes unaffordable. Generational wealth building, once the foundation of upward mobility, becomes impossible. This is not accidental. The Federal Reserve's tools interest rate manipulation and money creation benefit asset owners by design. There are no equivalent tools to help wage earners directly. Monetary policy structurally favors capital over labor. The middle class, which thrived under stable money, cannot survive in an era of unlimited money printing. The standard of living declines even as GDP and the stock market rise, because the gains flow to those who own assets, not to those who work for wages. The American middle class was built on stable money. When the dollar was backed by gold, purchasing power was preserved. Workers shared in productivity gains, and housing, education, and retirement were affordable. In 1971, that foundation was removed, and decades of money printing followed asset prices inflated. Wages stagnated, and wealth transferred systematically from workers to owners. The middle class did not fail. The money failed the middle class. The rise and fall of the U.S. middle class is the story of what happens when money loses its anchor. Stable money built prosperity. Unstable money destroyed it.